Hi guys. How are we all doing today? Welcome back to Ryan FX. So today I'm going to be answering a few questions that I asked my community the other day, and I genuinely wanted to know what it is that any of them might have been struggling with trading. I mean, the whole aim and goal of this process is to learn and get better, and I get that it gets difficult for we as traders from time to time, even I myself. Okay, so that's what we're going to be doing today. So take out time, watch this video, learn and enjoy. Share to your other friends, like, subscribe, wherever the case may be, wherever you find this video, be it on my YouTube, my Instagram, my Telegram, anywhere. Just make sure you share and help someone learn something today. So, so the first question being asked was, how do you identify a good structure and how to identify a very good order block? Okay, so let's just move into a different chart apart from what I am using presently. Okay, so first off, we need to understand what is structure. Okay, so structure basically is just the the movement of market and what direction the market is moving. Okay, so we have various types of structures. We have a bullish structure, which means that the market is pushing to the upside as buying. And then we also have a bearish structure, which means that the market is pushing to a lower to the lower side, means that there are sellers in the market. Okay. Then we also have a structure that we refer to as a sideways structure, meaning that the market is probably stuck within two definite price ranges. Okay, so this is the market stuck in two definite price ranges, for instance. So we have a bullish structure, we have a bearish structure, and then we have a sideways structure. Now, how then do we identify a good structure? So first of all is you need to understand what the key fundamentals are in terms of structure. Okay. So in a bullish structure, we expect that the market is making series of higher highs and higher lows. Okay. So we expect that the market is making series of higher highs and higher lows. This is this is the basic for any structure, any bullish structure. And for the bearish structure, we expect that prices are making lower highs and lower lows. Okay, there's reverse. And for a sideways structure, we want to expect that prices going from one support point to one resistance point in this manner. So this is what we then refer to as a sideways structure. Okay, good. So now, next thing you want to pay attention to identify a good structure is you want to be sure and certain that market is making good higher highs and higher lows in in a bullish market. And in a bearish market, you want to make sure that the market is making series of higher lows, sorry, lower highs rather, lower highs and good lower lows as well. So now, from this point, we would refer to this point here as, sorry. So we would refer to this point here as, we'll refer to this point here as point A, okay? And for the bullish structure, we'd refer to here as point A, and we would refer to the higher high as point B, okay? So, okay, so let's put here as point A. Let's put here as point B, and then let's put here as point C. Okay, so let's put it this way. Okay, so similarly, we're going to use A, B, and C for instance. Okay, we're going to use A, B. We're going to use A, B, and C as our reference point to pay attention to this structure entirely. So we're going to be focused more on the bearish and the bullish structure. Okay. So now the ideal thing is that for every time a in a bullish structure, for every time a higher low is created, okay, point B is created, we expect that a new higher high should be created. Okay, so first we want to identify the high, then we want to identify the higher low, then we want to anticipate the next higher high. So we want to go from point A, B creates point C. Okay. So similarly, in a bearish market, we want to focus more on where? On the high, on the lower highs, because in a bearish market, we want prices to pull to the downside, while in a bullish market, we want prices to push to the upside. Okay. So keep that in mind. And when you're talking about structure. So now we're going to identify point A as a swing high, and we're going to identify point B as a swing low in bullish terms. So meaning that whenever a high is created, a low is created, a new high must be created to break above the previous high. In the break of this previous high, we can then refer to that break of previous high as something referred to as a break of structure. Okay. Similarly, in the bearish market, when we get that break of the point A, which was the last previous lower low, we refer to it as a break of structure as well. Now, keynotes to remember is this. In a bullish market, in a bullish market, our higher highs are our weak points. They are our weak structures. Okay. So weak. So we have something we call a weak high. Okay. So we have a weak high. So we're going to refer to here as a weak high. And then in a bullish structure, we're expecting weak highs and strong lows. Okay. So we need strong lows, strong higher lows. So you call them strong lows or strong. H stands for high. Okay. Higher lows. Okay. So yeah, that's what we're looking for. So weak high and strong higher lows. Okay. Now, the reason why we say we want the higher lows to be strong is because we're in a bearish market. So we constantly need that support to push prices to the upside. So it means that every valid strong low or higher low should have the capability to break the previous weak high, which is our weak point of structure, and create a break of structure again for us to continue to push to the upside and then have prices pull back to the downside to correct, and then we move again. So at every point in time so we have like A, B, C, okay? Then C here would then create A, we start from here again. So we now have A, B, C. You understand? So it's just going to keep moving that way. So you want to pay attention to what the structure is and look at the structure. So if it's in a bullish structure, how you identify it is by clearly identifying that market is making a series of the fundamental basic of it, which is higher highs and higher lows. For a bearish market, we want to see market making lower highs and lower lows. So we have to always go from point A to point B, or from point A to point B to point C, like that. You understand? So we want to always pay attention from one swing low to the swing high to the swing low to the swing high, like that. And in that nature, you can then say, okay, you've identified, or you've been able to identify what a good structure overall. Okay. So now what's the next thing to do as well when you're looking at structure? When you want to identify structure, for me personally, I would want to view structure, okay, on I want to view structure from the higher time frame. So I would be looking to view structure, for instance, on the 4 hourly time frame, daily. Okay. So this would be my two major places to identify structure, 4 hours and daily. Now, sometimes depending on the kind of trader you are, you might want to pay focus, okay, on the 1 hour and 2 hour time frame. Okay. If you are if you are if you are an intraday trader, if you are an intraday trader, okay? Okay, but if you're a swing trader, 4 hourly and daily time frame is majorly where you're going to pick your structure from. Now, regardless of wherever the case may be, I would always advise that you study what the structure is on the 4 hourly and the daily time frame. Okay. So now another good thing to pay note to in identifying proper structure is you first want to pay attention to how the market is moving. Okay. So coming from I know coming from, from your intermediary class or your beginners class, you've always learned that the market is going to do something called a break, and a retest. Now, what I want to let you know is that a break and a retest isn't a guarantee that it is always going to happen immediately. The most important thing to structure is that prices makes a high and makes a low that fails to break the previous low. Okay. So as you can see, each of these lows that have been created here have in nowhere broken or invalidated each other. Do you see? They are all constantly making highs to the upside. But the most important thing is that they are all pulling back into a discounted level. You can see from the last swing low to this swing high, from this swing low to this swing high, we see prices pulled back distinctively into a deeper level before moving it to the upside again. Okay. Now, the break and retest is not a lie. It would happen. Okay. But sometimes it might take a while for it to happen. So this was a previous high that was broken. And what can you see? You can see that prices didn't retest it immediately, but the retest eventually did happen on the second break. And then it retested. It became a valid level and a discounted level for the last swing point. So breaks and retests are valid and they work, but they just don't work as textbook as you see them. Okay. So the most important thing for you in studying structure is to identify that a valid pullback has happened, and not just a valid pullback that has happened, but a pullback that has failed to break the previous swing low or the previous strong low. Remember, we said strong lows because strong lows, we call them strong lows because they are responsible for taking out what weak highs. So similarly, in a bearish market, this would be strong highs. Okay, this would be our strong highs here, and this would be our strong lows here. Let me just type that in quickly. Okay, so for the bearish market, our lower highs would be LH stands for lower highs. Okay, don't forget that they would be identified as strong highs. Now, why they would be identified or why we're identifying them as strong highs, it is because in the bearish market, we want that prices is constantly being pushed to the lower side. So if prices need to constantly push the lower side, it means that at this point, our resistance points are of key importance to us. Okay, while the lower lows, we're going to identify them as LL means lower lows. Okay, and then we're going to identify them as what? Our weak lows. Now you can see that there's a difference here. So you can see now that there's a difference here. Okay, here we have strong lows, strong higher lows, but here we have weak lows. That's because that we constantly expect prices to ram into the downside. So we expect that these lows are constantly breaking and prices keeps going in and pulling back and going in and pulling back. So these are the areas of the market that needs to be validated by the strong lows. Okay, similarly, just as I was explaining on the bullish side. Okay, so that is exactly what we need to find. So we do not want to see at any point that a low breaks a previous low. If a low breaks a previous low, it simply means that an invalidation has happened to that structure. So we need prices to keep at a good discount point and give us good price action to continue to push to the upside. So like I said, pay attention to the fundamentals of it. Higher highs, higher lows, higher highs, higher lows. Sometimes you might have an internal play of structure, and that's because the market isn't a straight line. So if this, for instance, is a 4 hour structure, it means that this swing low here, this strong low here to this weak high here that was created, obviously on a 15 minutes time frame would have created a bullish trend. So when you go to your 15 minutes time frame, you should see, the market trending, creating breaks and retest, buyers and sellers, because the market is in an idle field. So similarly, for the pullback here, or the retracement, whatever you decide to call it, but I like to call it a pullback and a push up. So on the pullback here, would also get like a smaller trend too as well before we engage and finally find a footing for a good support to create a new low and push to the upside. Now, mind you, you can't identify a higher low as a strong low immediately, except it has broken a weak high. So we can only identify a strong low after a weak high has been broken. And then this strong low now becomes our point of invalidation. And we do not want prices to break below these lows. Instead, we want prices to stay within this range at a discounted point, anywhere between 50% of it or 61 to 70% of this swing low to this swing high here. And then we expect that we start to see price action and an exhaustion of the previous sellers for prices to do what? Buy to the upside. Okay. That being said, let's move onto the charts and let's identify the structures. Okay. So I want to keep this. I wouldn't want to wipe it away. Okay. So like I said, let's go to the 4 hourly time frame, or let's use the 1 hour time frame to just identify structure here. Okay. Let's see. Okay, so let's take for instance here. So the market from this point we can see has been going up to the upside. Okay. Now, what are the first things we said we want to identify? We want to identify that the market is moving where? To the upside, because the candles are clearly going to the upside. So first we want to pick out this low. So you see we had a high here, then we had a low, and this high did what? Created a new high to this point, created a low, created a high to this point, created a low, created a high to this point, created a low, created a high to this point. Okay. So this is just me extending. Okay. But so here we'll just find where this high broke immediately here. And then what do we have? We have another low. And then what? We have a high, and then we have a low, and then prices just shot to the upside. So what can you identify first of all is the question. So you can easily start to identify that, oh, okay, prices created a higher low, then we had a higher high. This higher high here got broken up by what? By this lows that was created here, and prices broke above, creating a new weak high, a new higher high. Prices sold off from this point here and did what again? Broke above. So we now created a new higher high. This were the lows created by this high, and prices moved from this point again and did what? Broke above this previous weak high. Okay. And then prices came back to the downside. Okay. After breaking this high properly, came back to the downside. So pick this two. And then what happened again? Prices did what? Pushed to the upside, sold off, and then went all the way up. So now what can you identify? Higher highs, okay, and what? Higher lows. But now I want you to understand what I said towards the ending part of that video not long ago, where we're on the lines. And I said that, remember, the market isn't a free, isn't an idle point where you just lines like this. You get, as you can see, from this higher low to this higher high here, from this higher low to this higher low here, you can see that there was a trend. I don't know if you can see it. You can see that trend. You can see that trend here. You can see that internal structure that I was talking about. You can also see that from this low here to this new high, you can also see that there was a trend. There was a trend at this point to here. From this high to this low, before we created this lows here, you can also see that there was what? There was a trend. So similarly, is one of the confusion that most people might experience. So what you want to do when you want to identify structure is identify the swing points. Okay, so you want to identify the swing points, not just the trends. So some people end up focusing a lot on the trend. So identify the swing points. What I mean by swing points now are those major levels of turning points in the market where you can see a huge momentum and influx, of money or prices coming to the market. So you take, for instance, from here, you can see how this bullish trend shifted and became bearish. This point moved the market again. So these are like points where you can use to identify the actual structure of the market. And then you can then go and scale to your lower time frame and do what? Identify the trend on the lower time frame and make sure that you don't make a mistake and you don't miss it out. If you were paying attention to just your 15 minutes time frame, you probably would be stuck in this trend to the downside here, this 15 minutes trend here to the downside, and think you're going to stay bearish always. But if you move to your higher time frame and you identify that, oh, we're in a bullish structure overall, then you now have an understanding to know that this is just what this is just a retracement or a pullback toward to the the discount between this what this swing, this higher low here to this higher high that was created. Remember, I said we want to find prices around where 50, 61 to 70%, and then prices will continue. And at this point, we did 70% and prices went to the upside. So that is how you can easily identify structure. Okay, so similarly, if we're going to look for, let's look for a bear structure. Okay, this market has highly been bullish for a while. Okay, so at this from this junction here, and I think we can get a very good we can get a very good identification of structure here for bearish structure here. So you can see and you can easily map that. What did the market make? So the market was creating a higher high there, then failed to create a new higher high. Then what happened? We start to see the market create lower highs and what lower lows like this. Okay. So we didn't get the other lower low though, but you can use here to just picture what I'm talking about. Okay. So you see, we had this high, then we had this failed higher high, meaning that we then had a higher low, and then prices started to do a move to the downside. So you can easily identify that what this is a lower low, this is a lower high. Okay, prices broke this point here from this lower high here, and then we created a new lower low, then we created a new lower high, then we created what? A new lower low. So that is how you identify structures, not just by the internal trend, but you want to find the points of the turning points or points of reversals or point of continuations. Okay. So this was a point of reversal here. This was a point of continuation. Okay. Like that. So you can use higher time frames, makes structure easier to see and to identify. And then you can just focus on the smaller time frame trend to make entries. You can focus on that for like, okay, so for instance, here now, we understood that, okay, the market had broken this week low here from this highs, meaning that from this point on now, every other thing should be bearish. Now we can easily, plot out our basic support and resistance. Okay, so let me just clean this out quickly. So now we can easily, map out our normal support resistance. Prices comes into support and sold off. Prices came into support and sold off. You understand? Like that, like that, like that. But doesn't mean that they are the overall structure. They could just be internal structure. So take, for instance, you decide to buy at this point because on your 15 minutes time frame, it looks bullish, but it doesn't mean it was going to last forever. And then prices sold off against you. That was because what happened here was just an internal structure. Okay, so you want to always use the higher time frame to have a sight, an on-site and play on what the actual structure is. With this that I have easily explained now, I hope it makes it easier for you to identify structure next time. So Cheers, and I hope this video makes it easier for you to kind of identify structure. I would be making more videos extensively on structure in coming days, and when I do, I would link them back to this video. So you could come back to this video, subscribe, and turn on post notifications on any channel you're watching this so that you have like a more detailed and extensive video on structure in just not the standard retail way, but in application to smart money ways and fully understanding the difference between major structures and minor structures. So I'll see you guys on the next video. Have a great day. Bye.